There are 7 institutional reference points, each of which you can use to make money from the market, and each of them have a specific trading approach you should be using to execute an entry in your trading. Hello guys, my name is Bala Francis, and in today's episode, I'm going to show you just one powerful entry strategy using the fair value gap to execute an entry in your trading. Just make sure you watch the video till the end, like and subscribe to this channel so you stay updated every time I post a video. Let's get started. So guys, welcome back. So today we are going to be learning a powerful trading strategy using the fair value gap to execute an entry on the lower time frame, and specifically we are looking at the 15 minutes time frame because I'm teaching you a day trading strategy and our target is simple. All right, targeting between 40 pips to 50 pips on every day that we see this setup unfolding in the marketplace. Okay, so what is a fair value gap? A fair value gap is a 3-candle price action where the low of the first candle doesn't match with the high of the third candle. Okay, I'm going to show you quickly what that means. Or the opposite, it's a 3-candle price action where the low of the first candle doesn't match with the high of the third candle. So for example, if you had a bearish price action where this is a candlestick and this is the low, this is the high of that candle, this is the first candle, this is the second candle, and you have a third candle. All right, situations where you have the low of the first candle not matching up with the high of the third candle, that is simply called a fair value gap. All right, as simple as that is what a fair value gap is. Okay, then if price is bullish and you have a 3-candle price action where this is the first candle, we have a second candle, and you have a third candle, then the high of the first candle doesn't match with the low of the third candle, that is a fair value gap. You can take out time to watch the other videos on the channel. There's a specific video where I taught all the 7 institutional reference points. You can just go to that video and you're going to get a lot of information from that video. All right, but this is simply what fair value gap is. Simply a 3-candle price action that creates an inefficiency between the first candle and the third candle. There is an inefficiency. All right, an efficient price action is simply a scenario where the third candle usually will match up with the first candle, meaning that there is no gap in between the first and the third candle price action. An efficient price action is usually a scenario where there is efficiency in price delivery, meaning that there is no gap created between the first candle and the third candle price action, meaning that the low of the first candle is going to match up with the opening or the high of that first candle. The low of the third candle will match up with the high of that first candle. That's an efficient price delivery. But situations where there is this gap, distance between the low of the third and the high of the first, or the low of the first and the high of the third, this is called an inefficient price action. Usually the institutions will like to revisit this. They would like to go back to that trade level. You like to go back to that inefficiency and take up an entry from there, and we are looking for just 40 pips from this entry. All right, with our stop loss above the high of the entire range, or the high of the fair value or the entire range. That's what we are looking for. Now, situations where you have a gap that was created, more than one gap created, we pay attention to the gap that is at the 50% of the entire range or above 50% of the range. All right, because usually we like to sell above 50%, which is premium, or at 50%, all right, which is equilibrium, and we like to buy at equilibrium or below equilibrium is discount level. Everything below equilibrium, remember I've taught you guys this. What this means is simply this. So for example, if you have 2 trading range between a high and a low, right, between the high here to the low, we will use our Fibonacci to measure, and 50% of this entire range is called equilibrium. Above 50% is premium, below 50% is discount. So when you have more than one fair value gap in this range that was created, we pick out the fair value gap that is at equilibrium or above equilibrium, which is at the premium of this entire range. So we like to see price trade at least into the fair value gap that is at equilibrium or above equilibrium before we sell this, and we are targeting just 40 pips to 50 pips of this price movement. We are targeting the next draw on liquidity. So how do we use this strategy? It's simple. The first thing we like to do is to identify institutional order flow of the higher time frame. All right, identify institutional order flow of the higher time frame, but because we are doing day trading, we'll be paying attention to the daily time frame. All right, so every day we come to the chart, we like to know what's happening on the daily time frame. We would like to identify the next draw on liquidity on the daily time frame, and it's very simple to do that. If we are in a bullish order flow, we would like to see price take out the highs of the previous daily candle. That's where the buy side liquidity is going to reside on the daily time frame. Okay, or would like to see price trade into the next drawn liquidity. This could be relative equal highs, relative equal lows, or fair value gaps above an old high above relative equal highs. All right, or fair value gaps below an old low or below relative equal lows. That's where the drawn liquidity is most likely going to reside. Okay, because institutions will usually do two things. It is either they are delivering into an external range liquidity, like I have taught you guys, or they are going to deliver into an internal range inefficiency. So it's either they are delivering into an internal range inefficiency before they continue, or they are trading into an external range. This is an external range liquidity because this is an old low. Okay, this is an old high, this is an old high. Those are external range liquidity. Okay guys, so once we identify institutional order flow of the daily time frame, then we would like to simply go down to the 15 minutes time frame, and on the 15 minutes time frame we are looking to see price trade either above or below the Asian session highs or lows. We would like to see price trade above or below the Asian session high or low. All right, to take our liquidity above Asian session high or low. This will usually happen in London session. So in London session, we are looking at the Asian session high to wait for price to take out the high or take out the low. Then the next thing we are looking for on the 15-minute time frame is we need to identify a shift in market structure, we need to see a shift of market structure. Then we need to identify the fair value gap that was created, identify the fair value gap that was formed, that was created. Okay, and we take an entry at 50% of the range, which is equilibrium, or above or below 50% of that range, above or below 50% of that range. Okay, that's what we are looking for. You see, we already have what we are looking for. Once we come to the chart, okay, at London session, never forget this, we have two sessions we are paying attention, London and New York session. So once we come at London session, the London session open, let's take note of the time. The London session kill zone is between 2 to 5 a.m. New York time. That's the standard, 2 to 5 a.m. New York time. You can convert this to your local time. All right, wherever country you are, just download Time Buddy app on your phone and look for 2 to 5 a.m. New York time. What is that time in your daylight savings and in your country local time? Check it out. Then that's the time you are looking to apply these things in your trading, irrespective of the pair that you are trading. Then when we now go to the New York session kill zone, because sometimes the trade may not unfold at the start of London, it may extend into the New York session, so we will wait to see these things happen before we execute our trade entry. The New York session kill zone is between 7 to 10 a.m. New York time, 7 to 10 a.m. New York time. You should convert this also to your local time, and you're going to see this. My trading view is set to GMT +1 Nigerian time. That's what my trading view time is set to. So you should set your own trading view time also to reflect your local time or the standard New York time. You can set it the way you want it to be. All right, guys. So the first criteria we are looking for institutional order flow of the daily time frame, we need to know what's going to happen on the daily time frame. We need to see the market structure of the daily time frame. Is price forming higher highs, higher lows, or are we forming lower low, lower highs on the daily time frame? All right, are we in a current retracement or are we in a current expansion on the daily time frame? We need to identify the drawn liquidity on the daily time frame. I'm going to do it step by step so you see it. Then we come down to the 15-minute time frame, and we are looking to see price trade above the Asian session high or low, and we are looking to see a shift of market structure, identify the fair value that was created, take an entry at 50% or above or below 50% of that entire range, that entire range that was created. That will be premium or discounts, and this is going to happen at London or the New York session. Okay, toasts. All right, so let's quickly go to the daily time frame. Let's just check the daily time frame. So quickly, let me show you something important. I did a review for this proprietary firm, Founder Pro. Founder Pro is an amazing proprietary firm, and here you can get funded with up to $200,000 real funds, not demo funds. And within the first week of your trading, you can take out up to 80% of your profit in an average of 8 hours processing time. All right, guys, so that means your first payout can be processed within 1 week. Once you pass the evaluation and you get funded, you can withdraw your first profit within the first week of your trading, within an 8 hours of average payout processing time. This is very, very amazing, and it's the only reason I'm advertising this firm, because you are going to get funded with real funds. You can start with $25,000 or even up to $200,000. Once you pass the challenge, you can study the rules of the evaluation here. Once you pass the evaluation, you are going to get funded with real funds, not demo funds. Guys, I want you to look at this. The reason why their evaluation is different from every other firm is because they are going to get you funded with real funds, and they need to know that this trader knows how to trade. That's why the first stage is 10% and the second stage is 8%. Once you can pass these evaluations, you're going to get funded with real funds. I'm going to show you how I'm trading my own personal evaluation. I'm already done with the first stage and I'm currently in the second stage of the evaluation. Another good thing is that you can use your credit card or cryptocurrency to make payments with this proprietary firm and get your account sent to your email address instantly. Funded by Reed Capital, $5 million scale-up plan, no time limits for your evaluation, 80% profit split, lowest targets in the industry, low cost because their spreads are very amazing, very little spread. You're going to get access in seconds. You get your fees refunded to you once you pass your evaluation, and during your first payout within 1 week of trading, any profit you make, you can take 80% of that profit. Guys, make sure you use the link in the description of the video to get started. You can click the link and register an account with Founder Pro, and if you use the coupon in the description of the video, you are going to get up to 20% discount. Once you use my coupon in the description of the video, you will get 20% discount for every account that you purchase with this proprietary firm. So this was the daily time frame. Let's just take a general study of the daily time frame. You can see price traded into an institutional reference point that was outlined here on the weekly time frame, and price gave us a displacement. You can see even on the daily time frame, this strategy is always playing out even on the daily time frame. Take a look at this. On the daily time frame, price created a displacement and created a fair value. Institutions went back to that fair value gap. That would be an entry if I was doing position trading, and that's engineered all of this price delivery. You can see that they created another fair value here. Price went back to that fair value. So you can see obviously we were in a bearish order flow on the daily because price has been forming a lower low, lower highs, lower low, lower highs on the daily time frame, creating a lower expansion, bullish retracement into that internal range institutional reference points. Most of the times you see order block, fair value gap here, fair value gap here, created another range here, price retraced into, take a look at this guys, fair value gap. You see that here, price went back into that fair value that was created between the first candle here to the third candle, that gap in between, that's the fair value gap. Institutions traded back into that level, that gap that was created here, that will have engineered an entry, created another expansion, and we have been bearish all this time. Where was the drawn liquidity? You can see the drawn liquidity here was the relative equal low. I think I outlined this in one of my commentary, made mention that the drawn liquidity is the relative equal lows here. So price has been piercing and heading for that level. The next drawn liquidity here is the volume imbalance right here. There's a volume imbalance right there. You can see that there is also a fair value gap below here. There is another liquidity residing below that old low here, and there is also some inefficiencies below here that should be rebalanced. Okay, I did all of this analysis. You should watch my previous commentary. And this also is a drawn liquidity, the relative equal low here. I have outlined all of those levels on my weekly time frame. So we are bearish on the daily time frame. We are just going to take a simple case study, all right, in, for example, a situation where this happens. So let's go to the 15 minutes time frame. So once you conclude your directional bias on the daily time frame, whether you are bullish or bearish, whether price is forming higher highs, higher lows, all right, you know where price is going next, because after every expansion that creates higher highs, we should see retracements to form higher lows. Okay, and usually we like to see longer expansions, smaller retracements. That's another hack. Longer expansions, smaller retracements, longer expansions, smaller retracements. So once you come to the 15-minute time frame, you can add this session kill zone indicator. It's very simple. It's going to show you it's going to show you the Asian session, the London and New York session, depends on what you pick. So just come here and click. Once you click here, then search for Asian session range and kill zone. Once you search for this and you click on it, then make sure you pick out the colors you want to see in the Asian session and the London and New York open. Any of it, just make sure you pick it. So we are going to take a simple hindsight study, and I'm going to show you how to apply this. Okay, so you can see that right here, if something happened, this was the Asian session, price traded below it, but we didn't get to see that shift of market structure, all right, until somewhere at the bond close. And at this point where price traded above the Asian high and gave us a shift of market structure lower because we were bearish, this will have been an entry, but except that the time doesn't match with the trade setup, or the trade setup rather is not matching with the time, because trading is time and price. We are only interested in executing when we see any of this trade setup unfold within the session kill zones, between the London and the New York kill zone. Okay, so we'll just pass on this. This is not a trade for us. Then we go to the next day, and on the next day, first you can see that our Asian session is unfolding, it's playing out now. Okay, so at London session, we are looking to see price trade either above or below the low of Asia if we are bullish, but we were bearish on the higher time frame, so we keep looking to sell the bearish expansions on the 15 minutes time frame. But we'll need to see price trade at least either above the high of Asia or slightly close to the high of Asia, then give us a shift of market structure bearish, and we are interested in taking a trade entry once price returns into that fair value gap that was created. So let's see this. Okay, so look at what happened here. Something very interesting happened. Look at this entire Asian session. Price traded almost close to the high of Asian session. All right, when you measure the high to the low of that Asian session, 50% of it is called equilibrium. And we are also interested in seeing price trade above 50% of the entire Asian session. Okay, if price does that and gives us a shift of market structure, or price takes out the high of Asia, gives us a shift of market structure, or price trades to the high of Asia and gives us a shift of market structure. And it's also the opposite if you are bullish. Okay guys, so look at this. Price does this at London. This is London open 7 a.m. GMT plus 1. Okay, which will be 2 a.m. New York time to 5 a.m. New York time. 2 to 5 a.m. New York time is 7 a.m. to around 10 a.m. GMT plus 1. So look at this. At the kill zone, price gave us a shift of market structure lower. Shift of market structure lower. So where will I be looking at to execute an entry? I'll be looking at the fair value that was created during this process of the shift of market structure. And at this point, we can see that only that fair value gap here was what was created. You can see this first candle low and the third candle high created that gap. So I'll be taking a short from that level. I'll just take a short here with my stop loss above the high of the range, like I told you, or the high of the fair value gap. When you measure this, usually it shouldn't be more than 10 to 15 pips. This is 9 pips. You can be a little bit liberal and extend it to 12 to 15 pips, but 10 pips also is a good stop loss. Then we are just targeting 1:3 or 1:4, between 40 to 50 pips. That's our trade target. But most importantly, we are looking for the next draw on liquidity. What is the next draw on liquidity? The next draw on liquidity would be the previous old low that was created, all right, the immediate low that was created, and also the higher time frame, the 1 hour, the 4 hour, the daily time frame draw on liquidity. So if we just do this, and we are targeting 1:4, that will be around 40 pips, because we are risking 10 pips. You can see that is 42 pips. So let's see if this trade setup unfolds, and we are only looking for one trade setup a day. In the day that this happens, we are looking for one trade setup, and we are only allowed to take this trade twice. So if I take this and it fails, and price creates another signature similar to this, I will still take another entry, risking 0.5% of my account or 1% of my account only 2 times a day. 0.5 to 1% only 2 times a day. And if I get my trade setup play out just once, I should be satisfied taking 40 pips in the day that this trade setup unfolds. Remember that day trading is not everyday trading, okay? Day trading is simply waiting for the day your trade setup is going to come to you. So let's play this and see if we get this trade play out exactly as we have projected right here. So look at this, guys. 40 pips has been delivered. 40 pips has been delivered. No stress or zero stress. Price took out liquidity right here. You can see above the highs that was created in Asian session. Price took out liquidity here. Price gave us a shift of market structure, created that fair value. That's our trade entry. And look at the expansion. It has delivered that 40 pips. And we are done for the day. We are waiting for the next trade setup to unfold in the next day. So we are just going to wait for the next trading day and look for the same criteria to unfold in the marketplace. So this is the next day, and we are looking to see price give us that liquidity grab above the highs of Asia or above the highs that were formed within the Asian session, all right, especially if they are at above 50% of the Asian session. We measure between the high to the low, 50%. You can see there are highs that were formed at 50% of the Asian session. So price takes out the high. We'll be looking to see a shift of market structure lower. Once this happens, then we'll be looking to see, all right, guys, just look at this. Something very interesting I'm seeing here. Price took out that high. Then in London session, you can see the time, right? The time is very important to you. 7 a.m. to 10 a.m. GMT plus 1, which is 2 to 5 a.m. New York Standard Time. Convert it to your local time. Did you see that we had a shift of market structure here? Price simply take out the liquidity above the high that is at 50% of the Asian session highs. You can see that within the Asian session, those highs that were formed. Price took out liquidity. In London, we saw a shift of market structure lower. Then price created something called an implied fair value gap. An implied fair value gap is a 3-candle price action where you measure the wick of 50% of the wick of the first candle and 50% of the wick of the third candle. That is also a type of a fair value gap. So when we measure this, we'll be taking out just 50% of the wick of the first candle. It's a type of fair value gap. So you can see this is 50%. Then we'll do the same for the third candle. We'll measure 50% of the high to the low of that candle wick of the third candle. 50%. This is 50%. So I'll be looking to do this at 50%. Okay, so we'll be looking for price to trade into that 50%, and that's where we'll be looking to execute our entry. So did you see that this is 50% of this thing is also a fair value gap, price traded into it, and that's where I will have executed a sell here with my stop loss above this high. All right, when you measure that, no more than 15 pips, and I'm targeting the next draw on liquidity. It's very obvious here that the next draw on liquidity is the previous daily low. Okay, that will be let's measure and see how many pips that will be. That's around 34 pips. Okay, and we are risking just 13 pips, targeting 34. That is 1:3. I don't think that's a very bad risk reward. So if we can get this on a day trading basics, the consistency of this strategy is what's going to make sense. Once we can be consistent with this, then you can make a lot of money. Okay guys, so let's see this. Let's play this and see. Did you see that price traded into that level very easily? We are done with this trading day and we just go to the next trading day. This is on a Friday, so we are looking for the next week, which is on a Monday. Let's still take 1 or 2 examples and see what happens in the next week as it unfolds. Oh, okay, I think this is the current time. This is Friday 23rd September 2023. So this is where we are now. So guys, I would like you to just go to the chart and try to first look for these things. You have to practice these things on your own. You have to train your eyes to see these things. Nobody can do the practice for you. All right, so go back to the chart, check out these things, do your hindsight study, do your back test, and see how many times you can get this in a week. And once you are consistent, then you can start trading this on a live account. Don't forget to like the video, share this video, subscribe to my channel, and until next time, I wish you good luck, good trading, stay safe.